Hello, this is Rich Canlione from CME Group Trading Floor, coming to you with today's segment, Technicals Driving the Economic Bus. Last several days we've seen Bernanke bulk and we've seen Draghi dodge. However, the market still is moving forward based on some of the economic releases, so the technicals begin to drive the bus. Europe still has its issues, still the issues with respect to the auctions, and the U.S., of course, still has its issues. Congress goes on recess. I think today's the first day they're on recess, and we're approaching the fiscal cliff. Nonetheless, earnings are 81% in, somewhat good, probably some of them beating better than expected, still not exactly what was looked for in terms of the top line. Brings us to the technicals driving the economic bus. Yesterday's S&P's technical day revalidated the 100-day moving average, 1351, as did the DAX. I don't know if a lot of you out there, day traders, technical traders, hedge funds, and the like, probably look at that because there's a direct correlation, obviously. The DAX did the same things. I believe we were in the 65-59 area, which is the 100-day for them. Interestingly enough, the German market is the only economy in the Eurozone that is not on the threshold of a recession, so that's why it stands out. Moving forward, so we have to play the technical bounce. Last major high in the S&P, 1405, that was May 1. Last major low, 1255, that was June 4th, which was actually a revalidation of the 200-day moving average. So the bounce is moving forward from that level, and here it brings us to today. By the way, in the DAX, those same numbers exist. 6885 was the bounce high on May 2nd in the DAX, and the subsequent low was 5917 on June 5th, which is essentially through their 200-day moving average as well. One thing you want to make a note of, 30-year yields, obviously as we see de-risking, you're seeing 30-year yields. The 50-day moving average and 30-year yield is 265. That should bring you just through the 150 even level in futures terms. The 100-day moving average, which is the last major top in yield, 289, and that should bring you to approximately 147.16 to 147.21. If this bounce materializes in the SPOOs and totally gets completed, that should bring you to further de-risking and get you into those levels in terms of bond yields. So it's against my better judgment to look at this way in terms of playing the technical bounce onto the rally, but that is what's in front of us. Given that we still have these issues in Europe, and given that we still have these issues when Congress comes back, but you have to play what the market is telling you. And at this point, the footnote is that in the last 3 to 4 days, what we've actually seen in terms of open interest in the S&Ps, this is why you're somewhat apprehensive about following the pattern into the rally. We've lost about 250,000 fungigated minis, which is approximately $14.5 billion into this rally. So what that suggests is a good portion of this rally is being funded by shorts getting taken off the table, which were on the table in front of our FOMC, which were on the table in front of Draghi's speech. And so the bets are getting off the table, and at this point, not necessarily participating in the rally and getting long, but at least coming off the table. Play the moving average as well. Play the bounce. This is Rich Canlione from CME Group Trading Floor signing off. Thank you.